We want to thank our primary sponsor and my employer by day, Nassau Financial Group. Our tagline is, working harder to be your carrier of choice. We support you with best-in-class service. We seek to keep things simple, and we'll have your back in the years to come. We're headquartered in Hartford, Connecticut, with $27 billion in assets and over 500,000 policyholders. We've been doing this a long time, 170 years, but we remain humble enough to always try to improve.
Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, how are you?
Good. Always glad to be here.
Yes, unfortunately, Mark Fitzgerald had a conflict today and can't join us, so it's up to you and I, or you and me, Ramsey.
Yeah.
Listen, we got a great guest. We actually got somebody in the trenches who's not only working with customers, but working with agents to help them with their customers, explain annuities and help solve complicated retirement issues. And I'd like to welcome Jeff Affronti, who is president of FSD Financial, and you can find him on annuityexperts.com. Jeff, welcome to our show.
Thank you. Nice to be here.
Yeah, well, first of all, can you just introduce yourself to our listeners and just kind of tell them what your practice is all about?
Sure. We are a distributor of fixed annuities. I've been doing this for 25 years. We've started in the business through a family. I'm a second generation in the business. My father ran the annuities for Crown Life Insurance Company, and basically I learned from, my initial jobs was in the design of products. So I worked with actuaries and all the pricing guys. My first day on the job, so I kind of started at that upper level, and it was very, very fortunate that I got to be on all those calls. It made a very nice base foundation for me to work off of for the last 25 years.
Yeah, well, first I'll throw the first question out. But tell us, customers over the last 3 or 4 months, what kind of questions are they asking? What kind of objections, are maybe newer objections? Maybe not maybe in this business nothing everything new is old. But what's the sentiment right now with consumers when you're talking about retirement planning and annuities?
Yeah, whether it's coming from the agents or their customers directly.
Yes.
Short-term products right now, especially on the MIGA field. We are not looking for 10-year lockups. It looks like a 3 to 5 year range. I've seen more 2-year annuities sold in the last 6 months than I ever remember being sold. So I would say short term right now is what people are looking at. Maybe hyperinflation concerns, unknown market concerns. So that's what I've seen. A lot of concern with the short term, being able to move, being able to react down the road. So they don't want to tie up their money forever on the traditional side, right? So that's the biggest thing I've noticed. And also a change from where over the last 10 years, with rates being so low, people were okay with a B-rated company, a B-plus rated company. I've seen that change recently a lot. They want A quality, A minus or better quality. That's been popping up from the customers, I guess, due to everything going on in the world, right? So those are the two things I've noticed that have changed, whereas we were selling 15 years ago, 7% for 10-year MIGAs. Now we're selling 2% for 3-year MIGAs. And that's where the customers seem to be happier.
And what is a 2-year MIGA yielding right now, roughly speaking?
You can get up to 215, and if you're not in one of those super regulated states, Florida, California, New York, where they kill your yield. But yeah, so you're talking 215 to 175 on the 2-year lockups.
Yeah, and what do you think is spurring the concern about, or more the greater focus on the rates? Because I agree, I've seen the same thing there. You still have B carriers solidly in the business, including one I work for. But it feels like the number of carriers in that B range have diminished. Is there one particular reason you could put your finger on why ratings matter more in the annuity space?
Yeah, just financially right now going forward. I think even from the agent side, the agents were more, we got to get the yield. We got to get the yield. So they were going for it. But now I think there is just this hyper concern about the economy. And if things go bad, how secure is your company? I mean, there was one company in the industry that had two names that recently is in rehabilitation, right? I'm not going to tell you who, but we know who it is. And that was a company that was B minus, I believe, rated, and we went with them because we wanted the yield. We took a chance. We normally would never do that. I normally want to talk to the people at the top, look at their financials, their reserves, right? Their surplus is very important. But we went with them. Everybody was going with them at the time, and boom, you got a problem, right? There was something with the books, something with the CEO was doing there, and they put everyone's locked in, right? So you got people, and I think the problem that might arise from that is as the 5 years mature on these, people are going to want their money to move. So, but again, it's a bad story, but it's also a good story that, hey, a company, no one lost any money, they're still getting their guaranteed yield. But I think also that's out there. There's these, it's happened now. The company did have a problem that sells MIGAs.
Can I ask, you brought up an interesting question, like what kind of work do you do to evaluate the company? So obviously the easy thing is to look at the AM Best rating, but it sounds like you dig into the numbers a little bit. Are you looking at statutory filings? Like what sort of due diligence do you do? Not so much that, more of their earnings, what they've done over the last few years, their surplus, is it going up, is it going down? We look at, are they introducing new products? Did they just stop selling all their products? Companies that stop selling products might look A today, but they're not. They're going to, what happens down the road. So we also look at who they just hire. Oh, is this guy over at this other company that he does this and he changes that and reduces sales? Or, do they bring someone else in new from that other company that they had great customer service and this company's going to increase their customer service? So all that matters to me when I look. But right now I'm looking mostly at surplus. If you got 14% surplus or you got 6% surplus, that's a big deal to me because, I still have sticker shock from the AIG days. When AIG was A++, came to my office with their top people, sell us, never had so many free looks, right? In that 30-day when they had that problem and got the bailout, that was A++. So if you got to look at they were tied into all that reinsurance and everything. So we look deeper into all that type of stuff. And definitely the people at the insurance company matter and the products they're selling matter.
Yeah, what type of relationship do you have with the carrier's management team where you put the most products? I mean, do you know the CEO, the president, the head of distribution? What level of relationships are you looking for? It also depends on the size of the company. So the $30 billion companies, I probably know my regional guy a lot better than, say, the fraternals I work with, where I know the president of the company and we talk, or the top second guy. So I guess it's more about the size of the company and the relationships I've had in the past. Some companies, I've known the guys for 20 years and they were sales reps and now they're top VPs. So it's all depends on that. And really, we don't spend a lot of time put on my wholesaling hat for a second. Insurance companies don't want phone calls. They want the phone calls coming to us, right? So we're going to be handling that. So a lot of times I like to know as much as the insurance company. And when I start with a new company, first thing I do is rip apart their specimen contracts on the products we're going to sell and get to know everything. So there's really not a lot of questions I should have unless it's about, policy commission schedules, something in that regard to even call up the company. Or if there's a special need, which exception, large premiums, that's usually where it comes into play. How important is the customer service at the carrier level? I remember having a discussion with some people at a team, one team I worked with, and it's, and I've actually seen this at a couple of companies where they say, well, the amount of service you want to give is just enough to be middle of the road. You don't get exceptional service, just service that sort of keeps people in place. Is that still true today?
Some companies have amazing service, or like super amazing, they go above and beyond, and then some just do the bare minimum, or you got to call and wait a long time. That's the biggest problem we have is when we're doing follow-up, right? And we got and I hear my office staff with the hold music going for 30, 35 minutes. That's time wasted. So that costs me money, and that, it lowers our service to whatever agent might be calling to talk about whatever else. So from that standpoint, product-wise, it's not going to stop me from selling a product. If the company's secure and it's a good product, we're going to sell it. And knowing going forward, we might warn the agent or the client, listen, historically, it's going to take you an hour to get someone on the phone over there, so send us an email if you have a question and we'll get back to you. And that's how we handle it. You take the path of least resistance, and you don't try to change a corporate mindset. You just kind of see how you can make it work for you.
So one of the things we talked about prior to coming on was your business model and how you work with other licensed agents, and it was really fascinating to hear you talk about it, because at the end of the day, you're working with life insurance agents who at a certain level you expect to understand the whole spectrum of life insurance products. But in fact, many of the people you talk to probably are really good at traditional life insurance or whole life, but don't do as much in annuities. So tell us about those conversations, that experience. Is it easier or harder than one would expect? How have you negotiated and sort of built your business around that?
Well, it's pretty easy. We just kind of go out there and tell them, if you have your clients, especially if your clients are selling life insurance, right? Those same clients you're selling life insurance are probably a good candidate for an annuity. They might be, right? They have assets, and you're going to have access to their financials, right? So what the agents want on the life side is a one-stop shop. They don't want to have to look all over and call every insurance company to see what's the best deal for my guy. So what I give is peace of mind in that you're going to come to me, we're going to offer you the best possible thing for your client. We're going to give you multiple solutions, and we're going to walk you through the presentation and the high and low points of how to sell that product. And it's not just life guys. It could be financial advisors that are amazingly gifted at making money in the market, but they don't understand annuities. So annuities might be very confusing to someone who doesn't understand them. Like when I started in the business, life insurance, the term and whole, I didn't know the difference basically, because I didn't deal with it every day. But I knew everything there was about an immediate annuity. So when the life guy calls in, we're going to want him to give us just some basic information. Client age, what are they looking for? Do they need certain withdrawals or provisions, and their time horizon? And we're going to put together a plan for them on that. Usually the life insurance guys aren't the ones out there doing huge planning. They're not out there trying to do the full financial plan. It's a kind of value-added service. Look, you have money in a CD. It's earning 0.85%. There's things called annuities that earn 2%, and you tax deferral, and they go through that. And we explain that. They understand tax deferral. They understand those basic concepts. They just understand how the annuity works. So if you can break it down to a fact sheet basically for them, here's your talking points for this particular client, it makes it real easy. And then once they do one or two of them, they're really comfortable. And we don't get into super complex indexed annuities with these crazy, marketing buckets. These guys are they want guarantees, and they want their clients to be comfortable knowing exactly what they're going to get at the end of the term. So that's what I think the life insurance agent is looking for, more of a simplistic, easy to present to their client. They don't want to relearn a whole new system.
How many choices are the right number of choices for agents? So you don't overwhelm them, but you're not giving such a limited selection that they don't feel confident presenting options to their clients.
My last one we did was a few days ago, and we had 4 options for the client. And the reason we had 4 options was because each product worked a little differently, right? These MIGAs are now like a la carte products. You can add what you want to them and take what you want. So there's 4 products. One had no surrender after the 3rd year. One was a 2-year. One was a 3-year. And there was a 4th product. I'm just drawing a blank on what was the difference on that one. It might add 10% free withdrawals, right? So we lay those 4 out, and then the agents, we make it simple for them. Do they want 3 or 2 years? Okay, 2-year, jump to this. They want 3-year, jump to this. Do they need withdrawals? Jump to this. So now we've limited 2 or 3 questions are at one product, and this is the best product right now for them for that particular reason. Don't want to make it too hard. I think if you overwhelm them with companies and products, they're going to become, let me think about it and get back to you.
Yeah. Well, we're likely to have an episode in the next couple of weeks, Ramsey. You and I haven't even talked about this, where we'll get one of our attorneys on talking about some of the best interest standards and how the fiduciary rule is getting rolled into a lot of states. How do you think that's going to change what you're doing, or will it have no impact on number of choices or how you present the options to the agents?
And the planning component that you mentioned too.
Oh, that's for me. Okay.
Yeah.
I thought you were talking to Ramsey. Sorry.
Sorry.
I'll have to think about it too.
Yes.
Yeah. I don't know. I don't really know how to answer that in a simple way.
Yeah.
No, I really don't.
Well, there's a lot of gray area. That's what we're going to talk about, and I'm just curious because we've had some discussions over long dinner about how much agents will have to change. Good agents will have to change their practice because Jeff, it sounds like you're giving options. You're giving a structure. If a regulator showed up at your doorstep, you'd have a process, a screening mechanism, and have not sort of steered people for a reason other than what they're looking for, or will it? Right. So that's
the best interest is something we've always worked on. It's not even a thought. This is something they made up. The best interest of the client, isn't that what we've always done? It's what I've always done. I didn't put commission. What's that? Oh, we figure that out after the deal's done. We don't even look at that. I honestly don't know what my commission is most of the time until after it's done. And I ask, what do we make on that one? And we know. Because it's not even in our practice. And now you have all these qualified money, or you have to do all this disclosure, right, on the commissions and everything. So what did the companies do? They lower the comp and raise the override to 400 points. So really, I can make it look beautiful on a piece of paper, like there's nothing wrong, but it's not the best interest. So I think it's just another form that's going to go. I haven't heard really anyone talk about it for the Secure Act on these lifetime income. These insurance companies give an exemption to agents, right? If you promote this lifetime income and you take these 4 different qualities of the insurance company, you are liability protected. I've requested it from every company, never got one of the 4 things. I want it in writing. It says I need it in writing. Companies don't have it in writing. Why? Because they haven't been sued on it yet. And that's the only time this comes into play is when a lawyer if there's a problem, they come and look at everything. So you don't know if it's in the best interest until someone comes looking in. And then what's in the best interest is, best records you kept, right? So we keep good records. Oh, this gentleman's 80 years old. He has an annuity already. He's buying another annuity with someone else. He wants it. And now we write all this stuff down in case there's a problem. Same with if you do especially, like, what is the most dangerous annuity? The most dangerous annuity for a client is a life-only annuity, right? Put $1 million in and die in a month, you lose $990,000, let's say, right? But what do you do? How do you protect yourself there? You get disclosures and other, extra disclosures. This is a life only. Do you have family? No or yes. Why are you doing a life only if you have family? So you need to protect yourself. Forget the forms these companies have. They're great. They're compliance. That's suitability to protect the company, not suitability really to protect you as an agent or your client. That's 100% on you. 100% on you to keep good records and know what your client wants. And the way we look at it is honesty, integrity, risk tolerance. What is your client's risk tolerance? If his risk tolerance is a MIGA, but you think an FIA for 5 years is better and you slide him into that, he wanted a MIGA. You put him in an FIA. And this is an actual story. This just happened. And now the 80-year-old guy is free looking the FIA because he didn't want an FIA. He wanted a MIGA. But not that the FIA wouldn't do better in the long run than his X% MIGA, but he wanted the MIGA. And that's where you're not going to have a complaint if you give him what he wants. If you give him an FIA, even if it's a suitable FIA, but he didn't want it, there's a complaint. Now you're in trouble because they're going to come and look and, oh, well, you didn't do this, you didn't do that on this 80-year-old client. So as long as you do the best thing for the client in the first place, all this stuff, I never had a problem in 25 years. Ever since my dad got sick 12 years ago and put me in charge of the company, and I haven't had a problem. I was all of a sudden one day put in charge, right? We just kept the quality, integrity, expertise, and I think it'll take care of itself. Sorry, I went long on that. Sorry.
All right. So one of the other areas that we talked about at a time was working with RAAs. So you work with other professionals in the insurance industry, other agents. What about RAAs? there's clearly growth potential there, but there are sort of certain impediments. Tell me how you've navigated. More importantly, like what needs to be done to sort of expand the business in that area, in your view?
It's all in the compensation. We got to figure out how to get these guys compensated fairly to where it's legitimate and it's fair to the consumer, the regulators, and the RIA, right? So I've been working with trying to break this RIA field for a long time. I work with another open source group, and we started a guaranteed retirement income program. It was called GRIP. And GRIP was set up to bring immediate annuities to the RIA channel by having commutable SPIAs with cash value. So what we wanted to do is build an immediate annuity that had mark-to-market cash value, surrender charges, whatever you took out minus 5%, and that's your value. And then that way they had a way to bill, and we wanted it all to go through the company. They have their own, right? All these RIAs have their own system in which they get paid through, where they have all their assets, right, accumulated, and they get paid on that system. So we wanted to find a way for these insurance companies to put these values in the future years through the RIA system. That way they had a cash value, and it looked like they were, monitoring these accounts or actively doing it. Unfortunately, the trail commission was closer to 0.25%, and these guys were looking for 100 points. And that's what killed it. It was simply that just the spread, and they feel like they can maybe do a better job at that point. There's easy for them to make a story or show some kind of illustration that, this is better than the SPIA. So it's
that's in part because they're sort of you can pick the return you want when you're illustrating, versus something where there's an actual guarantee.
Yes.
So that's interesting. I mean, so 0.25 point. I mean, that's probably about right. Like at the end of the day, the question comes down to whether is a SPIA a replacement for an equity portfolio, which may do really well over time but has a lot of risk, or is it a replacement for some part of all or some part of the fixed income part of the portfolio? And is 1% right against the fixed income portfolio? Probably not right there either. But that's not the way things are set up, as you experienced.
That seems to be like 1% seems to be the magic number. If we could figure out a way to pay them 10% on the SPIA over 10 years, it looks like they'd sell them.
Well, and we also talked about this just briefly, Jeff. Or, should I, rewrite my client agreement to, just charge a flat fee for income planning services? I mean, is that another solution that doesn't require a company to change, pricing structures?
That would be the best solution, I think. That
would work, and it would work for them. They wouldn't have to get licensed, or they could just get licensed and make the commission and just waive the fee, or use the commission to offset other fees they have from that client, which could be like a sales point for them as an RIA. Look, I made a commission, so I'm going to offset your fee on this other side. I mean, that's a way to do it too, I would suppose.
Yeah, I think, yeah, I could waive the fee, right? I could. Ramsey, you've been involved in this, right? I could set up my client agreement, and as long as I put those in the terms, right, I could bill that way. Take the fee, use it, keep the fee, offset others. I'm going to Jeff into territory I know a little bit about, security laws, but I'm certainly not an expert on this.
So I can't claim to know any more than you do on that one, Paul. But I think that it's the spirit of it is the right one, right? At the end of the day, you don't want any elements of the compensation structure to limit the choices of the consumer, particularly under a very well-defined best interest standard.
Yeah. Yeah. Now, Jeff, curious. Do you do any work with RAAs? I'm not sure if you're licensed. Your firm, is affiliated with a broker deal at this point.
No, we are 100% fixed only. I've never been in the securities. Don't want to get involved. Don't want a broker dealer. Broker dealers seem to kind of get in, and since broker dealers got into the FIA business only because they were losing money. I mean, I've been doing FIA since '95. I mean, the best ones have already been pulled off the shelf, right? We had FIAs that said 100% of the S&P minus 350. That was the whole deal. There was no other moving parts to the things when we started, right? So now they got involved, and now, we spent a lot of time training my father was a pension person for 20 years, so we started. All our guys were pension guys. Well, once the 151 and all these started coming out, and they wanted to now put these FIAs under the broker dealer. Oh, I got to leave you now. I got my securities guy. And then what they found out is, they don't really know a lot about this stuff, and they're not getting the best products. So I kind of call the broker dealers almost as like the parental units for these guys. And outside of that, I think the insurance, for the most part, the insurance agents I work with, unsupervised, are doing a really good job. They're selling 5-7 year stuff with 5% caps. One of my guys renews the last 4 years at a 6.4% S&P point-to-point cap. I mean, that's a great company, great renewal rates. So, I don't know. I need a broker dealer, but no. And long story short, no, we don't. I don't work with the broker dealers. We would be willing to work with a broker dealer. I think FSD Financial Services division of ABC Broker Dealer, if they want to do a traditional fixed side, we would be able to do something like that for them. But it seems a different channel that they want to go, product lines they're going down. FIAs with riders and stuff like that. We don't sell a lot of that because there's not a lot of demand for that in our practice.
We talked a good bit about MYGAs, and I agree, lots of pinup demand, lots right at this period. Coming from an insurance carrier, it's finding those assets to offset the liabilities are a challenge, right? And they're getting more. They're getting
for you, the insurance company.
Oh yes. Oh yeah.
You guys got go to the home loan bank and stuff, and there's other groups. We have other groups that do that. You talk to me afterwards about that.
All right, we will.
Yeah,
we will.
We were in the GIC business originally. The spread business is what my original.
Oh, okay.
Yeah, spread is where I started.
Well, in terms of the features, you mentioned them. Where do you think the features? What will the sort of key feature sets look like on MYGAs? Say 18 to 24 months out. What's your prediction, assuming that interest rates stay about where they are? So is it, you'll see a class focused with, greater liquidity, lower guaranteed rates? Do you see some? I've seen some MYGAs. I'm not sure how well they're selling, where you've got a sort of low guaranteed rate, but you've got fluctuation on what the actual rate may, be 2, 3, 4 years out. How much innovation do you see in the products?
Well, the MYGAs are guaranteed, right? The term should match, the rate should match the surrender. After that, MYGAs have changed from the original MYGA. MYGAs were very clean. MYGAs after the term, now you have a checking account or a savings account, basically, right? Mm-hmm. Now the companies are like, you got 30 days to make a decision. So that's where these companies are making their money, on the people that don't move, or you are forced to make a decision in that 30-day window. And if you don't, you just re-up, right? No suitability. The insurance company doesn't have to get suitability, but if you want to add $5,000 to it, you better darn hell have suitability. So the insurance companies are working on the profit on that side. And the ones that don't have a renewal 30-day window, they're dropping to the floor. So you're seeing that drop to the floor. And the people are either staying or going to move from that floor. So we have our best business for agents is we call the agent and say, oh, your client just matured from his 3-year annuity. They're offering you 1% now with no surrender charge. But if you'd like, you can re-up 3 years at their new money rate and earn a full commission. They call the client. Oh, did you like your last 3 years? Oh, yeah, I got exactly what you said. Oh, and by the way, the company was upgraded. Oh, this is great. Would you like to do it another 3 years? Yeah, I don't need that money. And boom. And those roll over instantly. Commissions are paid instantly. So the first sale is your hardest on a MYGA. MYGA clients are often renew clients. They're often, and they tell their friends about it. They do.
Yes.
They tell their friends about MYGAs. Whether their friends call you or not, may not, but they're happy with their MYGA product. So in the future, I don't see MYGAs changing a lot. I would like to see more riders maybe put on them. I've seen a couple of that for the people who don't want an index annuity. You can put the lifetime. But what I'd really like to see is people just push these annuitization values. All of them have guaranteed payout at the end. In the old MYGA illustrations, it show, at age 70, your income is X or your income is Y. I would like to see companies push that, since lifetime income is so being talked about and annuities are finally getting some proper quality marketing and advertising and good and the good side. I would really like to see them incorporate the annuitization factors into these MIGAS illustrations. Not that anyone's going to use them. You have the guaranteed and you have the assumed values. So you say your income if you want, but you never know what the future brings. If you got a cure for cancer and your longevity goes up, they might be good pricing. You never know. But I would like to see that part reemphasized more.
Yeah, and if I'm a life insurance agent and I'm comfortable, I'm doing term life insurance and a lot of index universal life insurance. If you think about sort of what typical sales processes look like, what the fact finders look like, what's your advice if I said, look, Jeff, I would like to include annuities, but I don't know, what should I be asking? What are the first 3 or 4 questions I should be asking to at least open the door to that conversation? Is it, do you own a CD?
That would be, if you want to sell a MIGA, that's your first question. Do you have money just sitting, earning? Did you notice bank rates are so low? Have you noticed? Have your bank are getting sticker shock? Do you have CDs? Have they renewed? Is it sticker shocking you? Or just simply, do you have money just sitting in a checking account? So it's harder now than it was in the past because we used to be able to use tax deferral, right, as a big thing. You have $1 million in a CD, you could be earning $40,000 a year. That's substantial. Now you're earning $2,500. So it's not going to change your tax, right? You're not worried about the tax deferral. As interest rates rise, which I think they're going to do, someone's been talking about hyperinflation. So let's say we do get a 2% bump in rates. Now your CDs maybe are at 3% at the bank. You earn $30,000 a year. Tax deferral is an important thing again, especially if taxes go up, right? And your income taxes go up. So tax deferral, one of the most basic reasons we use a deferred annuity, it will be important in the MIGA field. So you want to talk to them. Right? You have also using people that I had a recent high earner, and every dollar they made now is taxed at the highest possible bracket. They needed a little more income, kids in college, whatever. I've offered them an immediate annuity, right? A period certain to offset, get them to this next stage. They didn't realize you could get a 98%, draw your own money down at 98%, tax free. They'd always taking money out of their qualified plan, 100% taxable, 100% taxable. No one told them about this. They have advisors, no one's mentioning it. So that's where we come into the, you have a client that you sell life insurance to. A lot's happened in the last couple of years. Also, with the pension changes in the rules and these annuities now, you can put 401ks. Some insurance companies even do the TPA, the third-party administrating for you. So that's another thing. Have you looked at your 401k in the last 10 years? Are you top-heavy? You can be more top-heavy. That's a way in the door for the larger, for your corporations. Also, nonprofits right now. If any of your clients are nonprofit, they're probably earning nothing on their money. You can put 503s into annuities. They get the tax free, right? They're not even taxed. And we do have some no surrender at 2% for these guys. I mean, it exists. So why would I work with veterans associations. They know they don't want to leave their money at nothing. You put them in MIGAs and stuff, and they're super happy. They get 3 times the earnings they would get at their safe bank. So if you can get the people at the top of these 503s to realize, we can make more money, liquid, quarterly, it's another thing. So I know you do second to die, or you do key man insurance. Hey, key man insurance, probably own a business, probably can go in there and talk 401k, talk annuities. So right there is your in. But I think the problem the life guys has, they just have no experience. So give us 5 minutes. We'll give you a few talking points. See if, for the pension, see if you can just get a census of the 20 guys at your company, and we'll do a free review for you. That's all he has to do is get the census, and we'll do everything else, or the insurance company does everything else. And then they get comfortable as they do more and more cases, these life guys, and they become annuity guys in the long run.
Yeah. Well, this has been great. Ramsey, what we've covered a lot of topics. A lot of very practical topics.
Sure.
Any thoughts or final questions?
So yeah, look, it was great to cover all the various areas. In particular, it was good to get your perspective on the challenge in the RA space. I think that's something that the whole industry needs to continue to focus on. What you said most recently about 503s that was new to me. So I'm definitely intrigued by that. And just overall, it was great to meet you finally in person. As I know, we've seen each other on LinkedIn, a lot over the years. So it's great to meet in person.
Yeah, LinkedIn's a great thing, isn't LinkedIn great?
Mm-hmm.
It is.
It's really good quality information we get on there without all the games.
Exactly.
Yeah, that's what I like about it. It's clean, and I always looking at. There's always people sharing great articles.
Yeah.
The only other one thing I'd like to get your guys' opinion on is on the income riders. Do you think women are the only people that should buy income riders?
No. Why? I think you've got an answer there. That's yes. Let's challenge the question.
Look,
why?
If you're a male age 65 and you decide to pull the trigger, you get 5% payout. If you're a female age 65 and you decide to pull the trigger, you get 5% payout. How much longer do women live than men historically?
Yeah.
So you're saying that. So you're saying that the difference is if you bought a SPIA or you bought a DIA, you would have a different payout. I'm just saying for comparison purposes.
No, forget that. Oh yes, 100%.
Yeah,
sorry, Ramsey, yes.
There would be different pricing based on gender.
Gender based.
I think what you're saying is that if you buy a fixed annuity and you annuitize, there's no differentiation. So if it's priced off the average, then presumably females will be getting a better value. If they
joint, wouldn't you do a joint, two females in joint? Yeah. Wouldn't that be the best? So I just threw that out there. Just my mathematical mind. I'm like,
Yeah.
No one ever talks about it. Longevity, and there's no mortality pool there, right? There's no life. They don't care if you're man or female.
Yeah.
No, well, we actually do with the FIAs, but that's a whole. We'd have a long conversation on that. But Jeff, listen, thanks so much for your time. This was great. Where's the best place if people want to connect with you? On LinkedIn. We'll include your LinkedIn bio.
LinkedIn. We're on Rumble and on YouTube. AnnuityExpertsDOT.com.
Okay.
On YouTube and Annuity Experts on Rumble, Facebook as well, Annuity Experts, and LinkedIn. Yeah, and you can visit our website, AnnuityExperts.com.
Excellent. Hey, well, listen. Thanks so much, Ramsey. Thanks, and listen. Appreciate all the listeners. Join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.